Welcome back. Chris Verrone is here, head of technical and macro research at Strategas Research Partners. On any given day, Chris, we've noticed, like, I would say going back 6 months, sometimes the Dow's up and the NASDAQ's down. Other times, that's reversed. It hasn't been totally in sync, which I think it gives us an idea of some of the internal rotation that we've seen, even with the Russell and small caps versus large caps, tech versus non-tech, consumer goods. Guys like you watch that stuff. What's been happening for the past couple of weeks?
Well, I think it's been particularly on display since that early August low. And what's maybe underappreciated here is tech has really lost its grip on this market as the markets come off that August 4th, August 5th low. What's not involved? Where's Microsoft? Not here. No Google.
But Apple.
No ASML. Apple acts fine. But to be fair, Joe, that's been a leader for so tremendously long. Now, if you think about this in context of what's the new leadership, the REITs are working, the industrials are still good, the financials are very good. So I think, if anything, what you're seeing is the shift in character under the surface of the tape. I don't think it's bearish. I welcome the inclusion of all these sectors that haven't been involved for, in many cases, much of the year.
Well, rates, that's directly because of the potential cut in rates.
Yeah, how much?
Well, absolutely.
And how much of what you're seeing is interest rate related?
I think it's all yields. And, we were very against the grain earlier this year, thinking rates down, rates down, rates down. We're here at 380. I don't think we want to see yields go much lower from here. There's nothing under 10-year yields from about 380 to about 3.25. And if you're talking about 3.25 yields, you have to begin to wonder why. What's beginning to say about the economy?
We're still in that Goldilocks period, is what you're telling. That's what the market is kind of reading into this. Because if yields go lower, it's because there's a disaster and something's got to come down from up here.
That would be my suspicion. I think on the Goldilocks soft landing story, you need to keep these financials involved. If you look at the prior two soft landings, 94, 95, and 84, 85, what do they have in common? Financials were dominant. So I think it's essential that you keep these banks and these brokers. Now, you basically have a new high in Goldman Sachs. You have the regionals acting pretty good. It's essential that continues because you don't want this message of bond yields to become, what is it telling us about the economy? And remember, we're sitting here, the two-year yield's 3.95, the Fed funds rate 5.50. That's one of the largest spreads in history. I still think the bond market is screaming that this Fed better go, and if not go 25, certainly go 50 when you think about September.
It's kind of interesting that I sort of view it as the tail wagging the dog. So you're saying that there's nothing under 380 as a technical support. Yeah. So the next is 3.25. So you're saying if that were to happen, the technicals would tell you that the fundamentals had to deteriorate really quickly.
I think it's hard to come up with a benign excuse for why 10-year yield should be 3.25.
So if we see that happening, we may not even know that the economy is much weaker than we thought.
Yeah, and I think the clues within the equity market that we should just be aware of here is what is consumer discretionary doing, particularly relative to staples. It's a pair that we've looked at for years and years and years to get the market's perception of the economy. That's generally still okay. I would not want to see discretionary get worse from here. I think it tells the story of why would yields be much lower. And think about this evolution of the leadership, right? We've seen REITs improve, we've seen utilities improve. There's a little life to healthcare here. Staples generally not involved. If you begin to involve the staples, then you really begin to wonder, why is all this counter-cyclical leadership really starting to emerge?
It's almost as if the market, if that weakens, then that's what I mean by the tail wagging the dog. If we do see this, then the economy is not doing what we think it's doing.
And I think what's curious is, as yields have come down here, it really hasn't been great for tech. And that's the exact same thing you saw in late 94, 95. The Fed went with the non-recessionary rate cuts in July of 95. It put about a 12-month relative performance top in tech. From mid-95 through mid-96, tech underperformed by about 20% over the index. So I think in an environment the last couple years where you couldn't own bonds, so you kind of own tech in its replace, if you can own bonds, I'm not sure you need to own as much as the top of the market. And I think this improvement in the equal weight S&P at the expense of triple Qs or the semis is telling us that story here. And look at these semis. I know NVIDIA reports today, but a lot of them aren't involved anymore. No ASML. Micron's broken down. Where's Qualcomm? So even the semi move has gotten narrower here.
Mm-hmm. But the broadening makes you bullish still. That's a bottom line.
Yeah,
you don't expect it, so we're not going to go. I think maybe we can say, okay, I'm not gonna buy bond. That 380 is as low as we're going to get in your view.
I think it's essential we hold there if we're going to maintain the status quo, right? That's kind of.
But
our
we
job.
should hold there if what we think about the economy is correct.
Absolutely.
Okay.
And Joe, I would just add to it. If you look at these tech names, tech's lack of leadership here the last 4 or 5 weeks has not come at the expense of other sectors. The rest of the market's actually gotten better. I think we have to welcome that.